Last week was stopping just short of a capitulation type move and everybody really giving up because we did have, the seasonal strength, fairy whispering in our ears saying don't get too negative going into October. So now we get an extra little flush and repricing of the market. I would say, even though you mentioned some of those mega cap stocks taking it kind of hard today, in general, it's not really concentrated anywhere. Equal weight, small cap, NASDAQ 100, S&P 500, they're all kind of in the general zone of just down, getting a haircut on this bond move.
Kevin Gordon, we might be talking about 5% on the 10-year faster than we thought we would, even after the rise that we've seen.
Yeah.
We're at 480, a little bit north of that as we speak.
Yeah, I think there's probably some psychological level associated with 5. I'm much more in the camp where I think rate volatility matters more than just levels because, you've gone now into, back into kind of extreme sort of negative correlation between bond yields and stock prices, broadly for the S&P, especially for certain areas like tech and also utilities. And anytime you have moves to the upside like you've seen over the past 30 days or the past 60 days, similar to what you saw in October of last year and then sort of May, June of last year, that rapid rise in the 10-year and really across the curve. But that was kind of what had put a lot of downward pressure on equity. So I think as long as that continues and then vice versa, if you get maybe a little bit of a stabilization in not just rate volatility, but also for the dollar and oil, which it started to happen a little bit for oil, that probably helps alleviate some of the stress that you're seeing.
I mean, you've got, Mike, a lot of seasoned market watchers kind of weighing in on what they're seeing, and it doesn't seem to be all that difficult to understand, at least according to what they're talking about. Mohammed El-Arian tweeted earlier, last year markets were adjusting to higher rates, this year adjusting to rates staying higher for longer. It's like the Tepper commentary that we got last Friday. It is just a different environment, and no one really knows what the price should be relative to what the earnings are going to be.
Yeah.
The valuation of this market makes sense. It's the great unknown.
Well, and because it's moving too fast, to Kevin's point, it's not just about, again, plug it into the equation and what does 4.8% on the 10-year get you in terms of paying for earnings. Right now, I think a not so terrible scenario would be that somehow the economy hangs in there. Earnings estimates on a forward going basis for the next couple of quarters are not out of line with what we expect. And the market maybe can find its way. What I think is tough, though, is, and this has been the case for months, you're not going to liberate investors from the late cycle psychology, from this idea that it's when, not if, things buckle. Even if we go a year from now, we're still going to feel that way. And so that's why anything that moves fast and seems like indiscriminate selling, like the bond market seems right now, it gets you unnerved. And I understand that, but all that being considered, we're looking at like an 8% pullback in the S&P. The average stock's doing a whole lot worse than that. But at the index level, we're back to 4 months ago, where we first reached 4,200.
You make a good point, the words that you use. Malcolm, I'll come to you in just a second. I apologize. Indiscriminate selling. Like, it's one thing to see it, Mike, in the stock market, which is unnerving enough. But when you start seeing indiscriminate selling in the bond market, in treasuries, it's even more so, isn't it? Because of all the implications that come with it.
To a degree, yes. It's an enormous market. There's a lot of institutions that are just kind of passive owners of treasuries. That said, we do have some big buyers who are not there the way they were. We do have more supply. I think if you want to take some heart in corporate spreads remaining kind of tame, they have ticked up a little bit. Still, the yields are going up. The cost of debt's going up.